Hello and welcome to this special webinar from Fat Profits. My name's Roger Malik. I'll be your host for today, and I'm the head of client services in our Sydney head office. Joining me today in our investor webinar is our senior account manager, Edward Allen. Edward, welcome back to the webinar. How are you today?
Yeah, g'day, Roger. Very good. It's a clearer political scene, that's for sure, at the moment, and looking forward to the next quarter, basically.
Yep. Lots taking place in the markets, as we know, and the headline for today's webinar, is it time to buy equities? We've seen a lot of volatility in the last few weeks in particular, and this is a burning question a lot of investors are asking themselves. Should I buy? Should I hold? And there's a lot to cover today. So let's get into our presentation without any further ado. All our presentations from Fat Profits are general in nature. We don't provide any personal advice during these sessions. If you're looking for that, please see your financial planner or advisor. And also past performance is no indicator of future performance. Now, during today's webinar, we actually have around about 500 people logged in so far. That's max capacity. So what we'd appreciate, if you've got any questions, which I'm sure you will, we've got a Q&A at the end of the webinar, and you feel free to ask questions then. If you do have questions related to the topics we are discussing during the presentation, feel free to ask a question at that point in time, and we'll do our best to answer as many questions as we can. So what are we discussing today? Firstly, the big question, is it time to buy stocks? We'll give Fat Profits view there. Warren Buffett, he's going big at the moment. So there is a bit of a clue there as to what he thinks about the markets. We will also share a dividend portfolio, which we've been running for 12, 13 years now and producing very strong returns of 18%. And we'll give you a bit of a sneak peek there. Lithium nickel, absolutely hot on the off the press, and a lot of people talking about it. Dollar cost averaging, that's an investment strategy. We'll discuss that. We'll also give you a bit of a sneak peek into our members website, so you can see how that looks like. It gets you a bit of a feel. We'll share with you who Fat Profits are, what we do. There is a very special offer for those of you interested in joining our service today with the end of financial year fast approaching. We'll also look at financials. Is it time to buy them, or is it time to lock in some profits? Tech sector, what is the plan? That's another topic which a lot of investors are thinking about. We'll also be providing 6 stocks to avoid today. And finally, 2 hidden gems. And these are our absolute golden opportunities to be buying today. So plenty to discuss. Let's get into the market. So first, we'll talk about the macro. What is taking place around the world? Now, if you look at the global markets year to date, you will notice the only market which is in the green out of the major markets is FTSE, which is the UK market. They're actually up 0.7% year to date, and that is fantastic given what's going on in Europe as well as the US. And you will also notice second on this list is ASX, which is only down 5% year to date, and that is a remarkable achievement given. If you look at Dow Jones, of course, you look at S&P 500 taking a big hit, and the biggest out of them all is NASDAQ, which is really growth-focused stocks, especially tech stocks, taking a bit of a beating. So if you compare everything, all things being equal, ASX have actually stood up pretty well compared to our global peers. What are the catalysts? What's rocking the markets? Firstly, high inflation all around the world. Australia is only 5% with inflation. US over 8%. New Zealand running pretty high, as well as the other countries. Rising interest rates. Of course, we've seen interest rate rises all around the world, and Australia has also seen them so far, and there's a lot more to come. That impacts share markets. China lockdowns. They've been in severe lockdowns in the major cities, and that's also impacting. Finally, a slowdown in the US economy, and there are fears that they may go into a recession, which is an official name for 2 quarters in a row when the economy goes backwards. There are some concerns, and we'll dive into a few of them. So these are some of the main things affecting the markets. Now let's have a look at the S&P 500, which is arguably the benchmark index for everyone to follow. Now, if you look at this chart, it's pretty obvious. Back from 2020 lows, it's had a fantastic run, actually gone way beyond most people would have thought back in March 2020. But off late, from those huge peaks, we've seen a retreat of around 17 to 18%. Now, is this a complete surprise? Probably not for most people. I suppose the big question now, Ed, maybe we'll get your views as well to see what Fat Profits think. Are we going to expect further volatility in the US markets? Are we going to see a bit more or stability now and a bit of a rebound? What does Fat Profits think here?
Look, the simple answer is yes. We're continuing to see volatility in this market in particular. We predicted 15% at the start of the year correction for the Nasdaq, and we predicted a sell-off in tech-heavy stocks, small and large caps, and that's actually played out now, and it continues to play out. We'll see these short-term bounces. Value investors will come in, or speculators. Okay, probably not value investors. Probably value speculators will come in and try and push some of these stocks back up. We've seen a little bit of that already on some of our tech stocks on the ASX. Yeah, we see volatility to continue. We're at 27%. The Nasdaq's officially in a bear market at the moment. The S&P 500, not so the case, but generally a volatile period ahead. So we'll keep members posted accordingly. But at the moment, we're taking a cautious approach over the next quarter.
Okay, so the big question which will be coming up shortly, and we'll discuss that now, is it time to buy equities? And we'll talk about that in just a moment. But first, have a quick look at the ASX 200. Now, if you see this here, yes, of course, we have not risen as much as the US markets, of course, but we also haven't fallen as much from our recent highs of around 7,600. We're held up above the 7,000 point mark, and that's largely thanks to a few reasons. And one of those reasons, you look at that in your next slide, is our market is very different compared to the US. You look at financials and materials, nearly making 50% of our market. And because we're so heavy in those two sectors, generally speaking, financials have been very strong. Our banks in particular, they're well balanced. They've got plenty of cash in hand. The dividends have been rising steadily, as well as, of course, there've been share buybacks. So the banks are in good shape, and that's held up our market. Mining sector is up until probably the last month or so, when China's gone into lockdown, our mining stocks and mining sector has also held up very strong. In fact, we are in a super cycle in commodities. So those two sectors combined have held up our market better versus the others. Now, the big question here is where to from here? So a lot of people are now asking the question, is it time to buy equities? Now, the answer, just before we look at that, is also if you look at Nasdaq, as Edward mentioned earlier, Nasdaq is now officially in a bear market, which means over 20% drop in any market is considered to be now bear territory. Now, if you look at this chart, this shows you that the proportion of Nasdaq stocks trading 50% or more below their price peak since 2020 is rising. You can clearly see from January this year till now, the number of companies dropping below 50% compared to the recent highs is rising and rising, and that's not a great sign for that particular market. Now, Edward, let's get your thoughts here. Mr. Buffett, Warren Buffett, arguably the biggest investor or the best investor the world has ever seen, producing 25% returns year on year for the last 45 years in the market, unmatched to this date. He has recently gone absolutely big in shopping for equities. And here to quote the actual figures, he spent $58 billion, which is his biggest spend in years. Now, why would someone do that? I mean, obviously, for someone of his stature to invest that kind of money, there has to be a reason, and he must see some value in the current drop. But what are your thoughts there?
Well, firstly, he's a value investor, which Fat Profits, our whole strategy, our whole philosophy is about value investing since 2000, since we started. And he saw value in the market. So he's gone in on certain segments of the market. He's put 33 billion in the March quarter into the market on depressed stocks, good quality stocks that are simply down because the market's down. Fundamentals haven't changed much at all on these companies. So that's a big lead there. And some of those stocks are in our global equities portfolios, companies such as Activision, for instance, Blizzard, which is one of our biggest held stocks. So he's not shying away from tech stocks, but he's going for quality. He's not going for risk, and he's not going for speculation. He's going for companies that are making money, that are predicted to make more money in the future. So that's where he's spending his money. So it's a value investing approach. And the catalyst was, well, here's the risk and here's the potential reward. He's an experienced investor. He knows what he's doing, and he's gone into the market confidently, which is generally what we do when we put our buy recommendations during these mini crashes in the market.
Absolutely. Well, his old saying, as you can read on your screen now, is be greedy when others are fearful and be fearful when others are greedy. So he's putting, money where his mouth is. And, this is the biggest buying that he's done going back since 2008. So that just gives you confidence as an investor that this short-term downturn that we have seen, we probably have seen the worst of it. Having said that, our view is that volatility will continue, but if you've got value, as Edward said, if you've got value stocks, quality stocks, who infrastructure ready, their cash balances are strong, they have a competitive advantage over their peers, then this is a great time to be buying those stocks or accumulating those stocks as well. Now, the old saying, sell in May and go away, has that come true this year? Well, absolutely it has. May has been a pretty horrific month for the globe for multiple reasons we've stated earlier. And typically May can be a softer month, but what we normally suggest is this is a good time to accumulate stocks. Now, the old saying, money never sleeps, we totally believe in that. And this is a philosophy Fat Profits follows, that if you don't find a way to make money while you sleep, you will work until you die. And that's an old saying that my dad told me when I was quite young, is make sure that your money is making you money. And that's the way to become rich. And we follow that here at Fat Profits as well. Now, as an example, as we said at the beginning, we have an income portfolio for dividend investors. This is 21 stocks. Now, we're not sharing the exact stocks which normally appear on the left-hand side, but these 21 stocks we picked out of the top 200 ASX companies. Out of those 21 stocks, you can see the prices we bought them, the dates we bought them, obviously different dates over the years, the current prices, the dates we've holding them, the capital return per stock, the income return, which is the dividends collected per stock, and the total return, which is a combination of capital growth and dividends, and then a number which is total return per annum. So every stock shows you a bit of a story. But the bottom line is what we're looking for is an overall return from this portfolio of top 200 companies. And this is what gets our members excited, is the overall return per annum is 18.1% across these 21 stocks. Now that is a combination of 6% dividends and 12% in growth. Now, Ed, you've been with Fat Profits for almost 12 years now, or 11 years plus. You've seen this portfolio pretty much start around the time when you first started. What are your thoughts? I mean, a lot of members you speak to probably follow this portfolio or have taken some benefit out of this. What are your thoughts with this income portfolio?
Yeah, that's correct, Roger. I mean, we started this as a model portfolio out of our preferred Australian equities portfolio. So these are 21 to 22 stocks, hand selected by our analysts out of our preferred 50 to 55 stocks in our Australian equities portfolio, which have been put into a model portfolio. We update it 4 times a year, so once a quarter. We make some minor adjustments and we update the dividend projections for 12 months in advance. And that gives members some good information to make sure they've got the right stocks going into the next 6 to 12 months for their dividends. And then obviously outside of this, we've got some obviously some more speculative stocks or stocks that are outside of the ASX 200 in our equities and mining portfolio that can add a bit of variety around this portfolio. So yes, I do have a number of members I've been speaking to over the years that have followed this religiously. So obviously if you've got a very large super fund, you only need about maybe 200, 250 plus to be able to follow this religiously. And these are the returns. These are actual returns. So this is not something we made up in the last few weeks. These are actual returns over the last decade plus, 18.1% per annum. And the average term deposit during that period was about 1.5%. So just to show you here, so we've outperformed the market there. The capital returns are fantastic, but most investors go into this portfolio looking for that total income return, the income return, which was 24.3%. And not all these stocks were fully franked. Some were partially franked, some were half franked, and some were even unfranked, like the property stocks. So great diversification here as a guideline, but there are other stocks in our Australian equities portfolio that can add some value and add some variety to this portfolio as well.
All right, thank you for that. And this next table shows you, and we're happy to share a few names here. You can see on the left, this is a projection of this same portfolio of what percentage dividends you can expect to earn out of this portfolio. Now you can see a few names. We're happy to share a couple. ANZ is one of the banks that we own. In industrials, we own BHP, of course, which I'm sure a lot of people do own. Nine Entertainment is something we'll talk about in a moment. That's another stock we've added to this portfolio over time, and BWP Trust, which you may or may not have in your current portfolio. These are a few names. Now, the good thing about this projection, it shows you net yield financial year 21 percentage, financial year 22, and then you can see gross yield, which means obviously including franking credits. And on the extreme right-hand side, you can see every stock, whether it's fully franked or partially franked or unfranked. Now, the best part about this is if you look at the portfolio average right at the bottom, this will show you gross yield financial year 22 of 6% across board, which is quite respectable. I'm sure you'd agree. If you can get 6% yield from your current portfolio, let's say you got $1 million in the market, that's $60,000 in dividends that you'll collect twice a year, which is pretty healthy. But if you can't follow this portfolio absolutely to the dots, then you can cherry pick a few which obviously stand out. So the ones which are giving you 7, 8%, I mean, there's a few here you can see 8, 8.1%, 14%, 5.8, 6.7. So there's a few which go over. You can cherry pick those ones and just literally match this in your portfolio. So this is one of the first benefits you will have is this dividend portfolio, which is quite defensive, and it's generating 6% in yield and 12% in growth. So hopefully that gives you some ideas. Now, Nine Entertainment is one stock which is out of this portfolio, Ed. We've had this for quite some time. For people who don't know much about this company, although they've obviously watched Channel 9, I'm sure, and probably been streaming Stan as well, which is owned by Nine. But can you tell us a bit more about this company or why they've been very successful?
Yeah, just a leader in entertainment, and they haven't just put in the old Nine Entertainment, just had Channel 9 basically, but now it's an online space. There's live streaming, there's streaming services like Stan. So they've got revenue from obviously their advertising revenue comes from multiple sources. Big events during the year, like NRL, for instance, for Channel 9, the Australian Open, the election recently. So these are big events, and this is where they get their bulk of their revenue. So the income is not going to be a problem. Now, obviously, during COVID, there was a bit of an issue, but I remember we bought this stock during COVID for the low, I think it was around $1.20
$1.05 or $1.10, yeah.
Yeah, and that's when advertising revenue was at a multi-year low, a 3 to 5 year low. Obviously, pullback due to COVID. So that was the time to buy the stock. But still, at the moment, based on forward projections, there's plenty of value there. Group revenue 1.3 billion. It's a massive turnover. And look at that dividend there, 7 cents per share. And they've increased it in the first half of 2022 by 2 cents per share. So we forward project this, and that's the value of getting access to this information, because that income portfolio, I believe in the next quarter, we're about to project 2023 dividends, and that's in a rising interest rate environment. So that's going to be a key for our portfolio. It's the first time that we'll do a projection on dividends where interest rates have actually gone up in the last decade. So that's a key event for us, and it'll be interesting to see what the analysts are going to project going forward.
Absolutely. Thank you, Ed. And you can see on the charts here, look, we've held this stock from early days, from $1.05. We bought it multiple times over time. We've also sold half. And this is another thing which a lot of people struggle with, is knowing when to sell. So here's a classic example, pretty much very close to its top. We sold half at $3.02. And then when it came down, we bought it again. So multiple times we will manage the portfolio in sort of a 3 to 5 year time frame. We'll buy it a couple of times, but if we see an opportunity to sell, we will advise you as a member, so you'll know exactly what to do and free up some cash, which will come in handy. Next up is we've got a hidden gem. As we said, we've got 2 hidden gems today. So one of the first ones is a retail shopping center property company. They're in the top 50 on the ASX. It's a huge company worth about $9 billion. This is some of their recent financial results. And as you may be able to tell just briefly looking at this snapshot, their net property income has actually gone up by 10.7%. Their overall costs are actually down. Overall net profits after tax have also gone up by $650 million versus a loss last financial year. You can clearly see the variance right at the bottom. So there's been a turnaround of $1 billion. So all in all, the cash in the bank is actually looking much better than before. And this is a quarter by quarter, month by month difference. And you can see the latest update was very healthy for March 22, which was announced recently by this company. Overall, they're in very good shape, and we really like this company. So here's a few things. This is a top 50 ASX company. So if you're looking for a blue chip, we believe this is the most undervalued stock in the top 50 currently. Dividend yield is pretty healthy, 6.2%. They are in that dividend portfolio that we briefly shared with you earlier. They're currently trading at a 20% discount to the NTA, which is the net asset value, and that's a good thing. Pre-COVID, they were trading at $2.75. Currently, they're still at $1.85. So there is still a further 50% growth to be had in this stock. Will this happen overnight? No. If you look at the charts, it'll tell you the story, because you can clearly see pre-COVID, they were around that 275 mark. They dropped to around $1. And we bought it a few times. Now they moved past $1.85 and slowly and steadily climbing. The most important factor here is the cash balance has seen a $1 billion turnaround from 21 to 22. And that's going to provide a boost to the share price. The dividends have improved, and this is still trading at a pretty big discount to the NTA. So this is the first stock we will be sharing with you towards the end of today's webinar. We'll give you the details as to how you can get involved with this company. So stay tuned. So that's the first one you can add to your watch list. Next up is obviously Warren Buffett. We follow him quite religiously, and you do well to follow him, but he does mention that patience is the key. The stock market is a device for transferring money from the impatient to the patient. And in these volatile markets, when they go up and they go down, people can lose patience and just make decisions based on emotion. We discourage that, and we encourage you to stay true to your investing strategy. If you've got a 3 to 5 year time frame in mind, and you bought a bunch of stocks and you believe in them and you research them well and you're following them religiously, then it's best to accumulate them over a period of time. And there's a strategy which we'll share with you in a moment. Now, how do you make big money? Often they get asked these questions. They don't make money by trading, by buying and selling, No. These guys, they make money by holding stocks for a long period of time. And when I say long, it's not 1 or 2 years. That's not long. We're talking years and years and years. And that's how he's grown his wealth. And that's what we follow at Fat Profits. We're not into trading, buy today and sell next week for 5% or 10%. We're in it to win it. Now, Ed, you know, you've been with the Fat Profits for a long period of time. Can you tell us a bit about who we are, what we do?
Yeah, absolutely. Like the reason we're trusted in the industry, the reason I've been here for over 11 years, and you've been here for many years too, Roger, is that, you know, we have real money in the market. You know, most of our competitors, they're just providing insights. They generally copy and paste broker reports and put them in a newsletter, charge a couple of $100 for it. You can get all that stuff for free, to be honest. The reason we're trusted is that we have 9 managed accounts, we have 4 listed funds, and we have 2, I believe, almost 3 unlisted property funds as well. So members are given multiple options to diversify their portfolios, and we actually show them where we invest real money. That's the reason we've been successful. Angus puts his money in the house account. He declares it on the daily report, you know, where he's investing money from the house account, and he refers to the stocks in our managed accounts. All of that gives you ideas for your portfolio as a self-guided investor. So you're not buying and selling through us. We're not stockbrokers. We're not direct marketers. It's real money on real investments. And the easiest asset class to manage for a self-guided investor is equities, in particular in Australia, because most equity investors in Australia, more than 50%, manage their own super, self-managed super funds in particular, or super wrap accounts. So we've got a Sydney office there, we've got a London office, we've got a wealth management division, we've got credibility in the market, we've got performance figures over 22 years, and our people, you know, we've got senior people here that have been here for a long time. We don't just have a bunch of school kids or, you know, backpackers working here at Fat Profits. David Lennox is the most trusted mining analyst in the industry. He's called to, you know, people like Ausbiz, for instance. He's regularly on that CNBC, Australian Financial Review, and multiple media outlets for his comments on mining. You know, so when they want to comment on BHP, Rio, Fortescue, you know, Evolution Mining, Newcrest Mining, or even some of the smaller companies in lithium and nickel, they go to David for comments there, not only locally, but internationally as well. So he's got credibility there. He's worked for Colonial Mutual Life. You know, you can see the companies there, Suncorp Group, actively working as an analyst, portfolio manager, and fund manager prior to joining Fat Profits. So he's been Fat Profits, like myself, for well over a decade, and he's quite conservative, but he continues to pick winners, you know, winner after winner in our mining portfolio.
Absolutely.
Yeah.
Yep, thanks, Ed. And he's also a geologist as well. So we research all these companies. Our research team spends a fair bit of time. So I suppose for mum and dad investors out there, you won't have the resources to do the same, but also the time as well. That's another factor. So we can help you with that. And now, finally, we also have a wealth management division where we manage real money. So as Edward mentioned earlier, we may have 9 different managed accounts, and this is basically where you can park some money and we can manage it for you for an annual fee. And you can see the orange line, that's our Australian portfolio, and the black line is the Australian top 200 ASX. So obviously we compare against the benchmark index, and as you can see, we're clearly outperforming the markets consistently, and the orange line keeps going further and further away from the ASX. So we nearly tripled the market returns over this period of time. That is not a small achievement, let me tell you. Tripling the market over 15 years is very, very hard. Ask anyone out there, and you know this better than anyone else. So that's just to give you some credibility. Moving on now to a few more stock tips and sectors to cover. Next sector we're going to cover is soft commodities. Now, a lot of people often ignore this and not sure what to do here. But if you look at some of the prices on your screen, lots of green. You look at agricultural prices, wheat, soybeans, you look at cheese, milk, cotton, coffee, lots of green here. So the prices have gone up dramatically, and that's thanks to supply chain issues, rising inflation, the war in Ukraine. There's a lot going on, and you can clearly see the food inflation is here to stay. Prices are going through the roof. We all know that when we go grocery shopping, fruits and veggies are very expensive nowadays. There is another chart of wheat that's gone up as well. How can you benefit from this? There are a number of stocks, and we've highlighted them in the last 3 or 4 months in these free webinars, and people have bought them and made 30% gains in the last 3 months from 3 companies that we've listed, and those stocks have actually done quite well. We still got about 3 or 4 companies in that space, in agricultural and soft commodities, that we can highlight to you, and you can take advantage of them. Now, some of these hard commodity companies, here's a list of the top 10 companies on the ASX 200 last year, and we're proud to say that we picked 3 out of the top 5 last year. The first company, the best on the ASX by a mile, was Chalice Mining, CHN, and they shot out by 645% last year, followed by number 3, Hub24, which we also picked for our members, and number 5 was Oracobra, which has now changed its name to Allcam. So first, third, and fifth, we managed to pick gold, bronze, and whatever medal you say for fifth, which probably nobody cares in the Olympics. But that's our proud achievement. And some of these names have actually done exceptionally well. And we'll give you a couple of snapshots. Chalice Mining is a hold. We're not recommending a buy on this at the moment. It's still a hold. And if you look at its portfolio, that has got multiple commodities portfolio spread across the country. And Ed, you know this company quite well because a lot of your members have invested money into this, and they're sitting on some hefty gains.
Yeah, it's been one of our all-time biggest success stories. The thing is, we didn't come up with this stock overnight. We researched this stock for 10 years. So it was in our mining portfolio for well over 10 years. And when they finally made their first strike, their biggest discovery in 30 years, which was palladium, we had a buy, I believe, at around 17 cents on the stock. And then we've had multiple buys, and we've actually taken some profits along the way as well. But palladium was the game changer there. But they're also, look there, they've got battery metal stocks, nickel, copper, cobalt, very diversified portfolio. And they've just recently signed extension of land leases. So they're looking to further extend those strikes, especially around Julimar. So this is a huge winner for our members. We've had a number of these. We've had quite a few of these. Not as big as Chalice, but you mentioned Linus earlier. We had another rare earth company, but wasn't on that list because it wasn't an ASX top 200 stock. But it went from what, $1.43 to $14 in the same period of time, rare earths, and we had to buy multiple buys on that particular stock. So we've had a few of these over time, but you can clearly see there a 10K investment on a 10 bagger or a 20 bagger or a 100 bagger like these ones. But 10 bag is pretty good in any market. But you can show there these are real returns. These aren't hypothetical, because I've spoken to multiple members that put $10,000 in this stock at around 20 cents, and they're sitting on 200, $300,000 on this particular stock. So here's one gentleman who posted a review on his own accord, put $5,000 in at 12 cents. These are real returns in 2019. And then he accumulated, he actually added more, which is a strategy that we have. You build a stock over time. You don't put all your eggs in one basket. So if you're going to put 20,000 in this stock, you probably start with 5, 6, 7, 8, 9,000 to start off with, and then when the price is a little bit lower in the future for various reasons, like the mini crash that we've just experienced at the moment, you can accumulate more stocks over time. But he's turned that investment into $500,000, and he's only 33 years of age. So,
Wow.
and there's a few stories like this. There's a couple of gold stocks that popped recently where new members that were referred to us did similar things, and they told us, and they've got similar returns. Not as big as this one, but 10 bagger in this market. So if you buy a stock at 10 cents and it goes to $1, that's a 10 bagger, and that's a wonderful achievement in any market.
Yep, absolutely. Thanks, Ed. So this is our best stock last year, but Hub24 wasn't too far behind. They're a financial technology company. This was the third best stock on the ASX. And you can see there the financial numbers from 2017 to 2022 have grown and grown. Funds under management have grown and grown, and that's obviously helped their bottom line. And that's as simple as that. And that's largely thanks to the Royal Commission of the banks a few years ago. And a lot of money's come out of the banks and moved into these platforms. So we've been holding these stocks for a number of years. As you can see, initial buy was at $1.35. We bought it a number of times along the way, so $3, $5, $8, $10, and we bought them, accumulated this stock. And now, again, this is currently a hold. We're not recommending to buy at this stage, but a 10,000 investment there, we always go in that multiple, would currently be sitting on $175,000 there. This is another example of Warren Buffett's philosophy, is buy early, accumulate on the dips, and hold your position for a number of years, and that will make you wealthy. Not buying and selling 5 or 10% or 20% and doing the trading. That's not going to make you rich, because that goes up and goes down, and you lose and you win. So this is another example of our strategy that we follow. Talking about strategy, there's a strategy that a lot of people follow at some point in their life, and there's a bit of a joke in the stock market, so you might take it in a bit of a light way. And this guy's standing there obviously praying for something. And this is called the BHP strategy, where you buy a stock and sometimes it goes down, then you hold it, and then it goes further down, and then you start praying. So that's called the BHP strategy, buy, hold, and pray. And it happens quite a few times to all of us. And one of the strategies we use, and this is an example, Fortescue Metals, I mean, there's plenty of examples, but this one, if you look at it here, the stocks went up from $10 to 26, then it started dropping. You may have bought this stock at some stage. We did, we bought it at $20. So some investors popped in 10, 20, 50 grand at $20, and then it went down to 14. And they started thinking, gee, I've lost about 30%. What do I do now? So one of the strategies we use is, rather than you buy, hold, and pray, is dollar cost average. Is you buy them in multiple lots over a period of time. So we bought again at 14. We bought again, in fact, at 16, and we brought our average down to around about 16 and a half, $16.50. And now stock's gone up at $20 plus. So in its essence, if you bought it at 20 and it's now at 20, you haven't made much money, and you probably held it for 9 months. Maybe you've collected dividends, but that's about it. But if you average it out, you give yourself a chance of getting a better return plus dividends. And that's the strategy called dollar cost averaging. And you can clearly see on the charts here, you buy a stock multiple times on its way down and on its way up. You just buy it in regular intervals, and that reduces the chances of risk and increases the probability of success. And that's why we encourage at Fat Profits. So here's another example where you can see, if you'd bought a stock at $10, let's say you put in $800 at 10 bucks, and it goes up and then it goes down, and then it goes up and then down and down and down and down, back to $10, essentially you would have made no money on this stock if you bought it at 10 and it's today at 10. But if you buy that stock for $100 every month, regardless of up or down, and you just keep popping that money into that stock, that your average would be $8.16. Today's worth $10. Well, you made 20% return in that same period. And that's what we're talking about. So this works especially in volatile markets. And you can see here in the Dow Jones, in this period where you see the white arrow from 1929 to 1954, when the markets went down and then slowly but surely caught back up. So in that 25-year period, if you had bought using dollar cost averaging, if you keep investing $10,000 there each year on the 1st of January, you would get an 11.7% return per year, and you turn that $10,000 per year into $1.5 million. This just to give you an example that in volatile markets, this strategy is absolutely perfect. But of course, when you're in a bull market, it may backfire as well.
That's right, Roger, but only in the right stocks. If you did this in the tech sector in the last quarter,
Yes.
you know, from March onwards, you would have lost a lot more money. You know, if you average companies like, I don't know, ZipPay or Appen or, you know, just
A2
an
milk.
example, you know, Sezzle, for instance, which have almost gone broke. You've got to pick the right stocks. It's got to be good quality stocks. Otherwise, you can actually lose a lot more money chasing the wrong companies. So if you're buying quality companies that are paying good dividends, that have a growth trajectory, yes, that has worked for us in the past. But if you buy high risk speculative stocks like mining exploration stocks, for instance, which haven't even dug a single hole in the ground, that you bought on hype and you've lost on fundamentals, when the day traders move out and jump over to the next stock, if you start accumulating those stocks, it'll be the buy, hold, praise strategy, guaranteed, and it'll be for a very long time.
Very long time, a lot of pain, that's true.
Yeah.
All right, so talking about the sectors, and we will discuss a few stocks in a moment, the stocks certainly to avoid. But one thing which is certainly taking place is the technology sector has taken an absolute hammering, mainly thanks to rising inflation and rising interest rates. And we've been saying that for the last year and a half, that this is likely to happen when rates rise. And property is now starting to flatline, so you have to be careful there. The right stocks will still make you some money, but you have to be very careful. Financials and commodities, on the other hand, we're quite strong on, and we're quite bullish on. So one of the clear indicators is this chart here. You can see the blue line, which is the ASX 200, and the red line, which is the tech sector. So clearly there's a huge gap now because tech sector is going down, and it will go down further in our view as interest rates continue to rise. So something for you to keep an eye on. And here's a few stocks now we will also share with you to avoid. So we don't just tell you what to buy and sell, but to avoid. Now, recently, if you remember, Ed, Target in the US, huge company, of course, recently announced their earnings. And that was a big surprise to the market because their earnings went down in a heap. And the stock actually went down quite a fair bit, 25% on the day. What are your thoughts there on companies like these?
Yeah, the growth period for e-commerce in particular, and also big box and their growth strategies, as interest rates rise, you know, the purse string's going to tighten. You know, we've got, I think we've only got one exposure in this space, I believe, in our equities report, but there is a clear momentum shift. Here in Australia, obviously we have a Target as well, which is part of Wesfarmers. And Wesfarmers also own Kmart and the likes. And now the Australian dollar is at 70 cents. So these guys are going to be paying a lot more for their product. There is inflation pressure. So as people start buying less, they'll need to become more aggressive to sell more stock, which will squeeze their margins. So their profitability will be under pressure as they try to move stock quickly out of those stores. And remember, they're buying more, or they're paying more as they're exported out of China, for instance. So there's a lot of pressure on these companies, these retail stocks, right across the ASX and right globally, everywhere. If you've got a weak currency and you're importing, you're going to struggle in this environment. So we're keeping a close eye on this. This is just one example, but the market won't favor weak reports and weak market updates in the future. So anyone that comes out with a profit guidance which is less than what they projected, the stock will take a hit. So you need to make sure that you're doing the right thing in holding that stock right now in your portfolio.
All right, thank you. So the golden days for some of these e-commerce companies are behind us. Talking about Wesfarmers, you did mention that earlier. So some of you watching this webinar, and there's quite a few of you, probably own Wesfarmers or maybe thinking about buying it. Look, our view is we're avoiding Wesfarmers for the reasons Ed just stated earlier. We do believe the golden days, or at least the best days in the short term, are behind us. The highest peak price above $65 is certainly behind us. We don't see Wesfarmers going back to those highs as the purse strings start to tighten for the consumers. We do feel that the earnings for these companies will slow down, and that'll bring the share price down with it. So that's another stock we're avoiding. In fact, we've just got a comment now, Ed, from Michael, who says, "Oh, guys, great presentation so far." Saying, "I watched your webinar 2 months ago when you also mentioned about e-commerce and tech stocks, and I actually sold Wesfarmers back in 2 months ago." So thank you for that. So Michael, appreciate your comment. We're glad you've taken some advice which has worked for you. We're not always perfect, but we try and do our best we can. So we're glad it worked out for you. But for any others who are holding these stocks, was something for you to think about and maybe a bit more research for you to do. Next stock to avoid is A2 Milk. And this is another company which have been under a lot of pressure of late. So if you've been holding this stock from the highs of $20 down to $4 now, you're probably thinking and doing the BHP, buy, hold, and pray. But if you've been thinking about buying this stock at these levels, look, we've had numerous inquiries on A2 Milk when it was $10 and $8 and $6 to say, surely we can buy it now. But we've been holding our fire and we've avoided the stock. And even today at $4 something, we're avoiding the stock. There is a lot of challenges this company is facing. Until we see that happening, we will not be entering this stock. We only buy stocks when we've got full confidence in the company. Next one is AGL. Ed, you know this company quite well. They received an offer recently as well. That's probably propelled the share price, but still, fair bit of work for them to do ahead. So we're not confident with this one yet.
Brooks's investment company has pushed his share price back up on a takeover offer once it splits its businesses. So that's really been the catalyst of the share price turnaround. Fundamentally, high energy wholesale costs and rising costs in particular for AGL still remain the same. So fundamentally, not much has changed. There is a bit of interest in when they split their business. But yeah, Brooks is the reason why this share price has gone back up. So fundamentally, still very weak. And yeah, definitely we're still avoiding. There's much better stocks out there.
Much better stocks, absolutely.
When he crashed.
Absolutely. Exactly right. So that's another one to avoid. Another one is Zip Pay. We've talked about this many times. Michael, you remember this from previous free webinars we've done for investors out there. Zip, buy now, pay later. We've been saying this was a bubble. It will burst. It has burst. And Zip has come down from $14 down to under $1. And we feel sorry for anyone who's bought it at $14 or $10 or $8 or even $6. But we've been avoiding it and we still maintain our position. So if you're thinking about buying it at the moment, our view is avoid. Another stock is, last one is Magellan Financial. Now this is a company we know quite well. We've held this stock from, as you can see on the charts, from early days when they were $1.74, still a small cap back then. And we've held it. We've seen the rise of this company and they've become huge sponsors of big events like the Ashes, and they become a household name. We sold them at $25.82 and we locked in a big gain at the time thinking it was fine. Obviously the stock's gone up even further, so we don't get it right absolutely all the time. We are humans after all, but the stock has crashed in the last 1 year. If you've been still holding this stock, well, you may just hold it for a time being, but if you've been thinking about buying it, look, no chance for us for now until we see a bit more clear picture. But currently that's another stock we are avoiding.
Including
Moving on.
dividends, Roger, it's almost a 20 bag of that stock, including dividends. So that was
Yes.
fantastic for us. So we're very happy with that return.
Yep.
And yeah, timing in the market is absolutely everything. And yeah, most people, sometimes you can get lucky and time it a couple of times, you can get it right. But yeah, we timed it on fundamentals and made a good profit and moved away. And we put that money into other stocks, which we've done very well during that period of time as well.
Excellent. Before we look at another hidden gem in a moment, we'll also tell you that we will normally advise our members also when to sell. And this is usually a bit of a pain point for investors because knowing when to sell can be probably the most tricky part. Here you can see probably about 13 stocks on the left. We've sold them in the last 12 months. Some of them are half sells, some of them full sells. As we said earlier, we work on 10K capital investments as a bit of a benchmark. Some invest more, some less, but you can see the gains we've had and of course the losses we've had. We don't get them all right. There's a couple of losses there in between all the winners, but generally speaking, we've done quite well. So Ed, any comments? There's no entertainment there, as we said earlier,
Yep.
and we did a
Yep.
half sell there, a 302. Yeah.
Yep, absolutely. So we selectively sell. Again, those losses are usually on small caps, and small caps do carry the highest level of risk. But yeah, we've had some takeover offers there as well. With Mainstream in particular was a beauty. We also got out of those Asian stocks, those Chinese ETFs,
Mm.
China A shares. And also Platinum Asia at an absolute opportune time. I mean, the timing couldn't have been more perfect to get out of those two.
Mm.
The main was a really good sell as well. That was
Domino's
fantastic. So
Pizza, not bad. 'Cause they're down
Domino's
at the moment.
fantastic at
So some of
110.
these stocks we've gone back as buys after we sold them because we understand the fundamentals. But this is just another example of how we can help you. Is to when to sell. Moving on to another buy recommendation for you in hard commodities. Just before we do that, this is a chart of US dollar, which is obviously been strengthening over the last 12 months. And you may or may not know this, but if the US dollar is stronger, then that affects the mining commodity prices. So a weaker US dollar is typically better for commodity prices. But in spite of the US dollar being strong, you will notice here that the hard commodities have still had a pretty good run. Lithium in particular is a standout in this screen, but all the others have also had a pretty good run. Here's another example of some other commodities. Coal has been very strong. Nickel has been another standout. You can see those two standing out amongst the crowd. So we're going to share with you one of those commodities. In fact, both lithium and nickel, they are used for electric batteries, for cars, mobiles, you name it. They're used for all kinds of stuff now. And you can see the chart for nickel. In the last 3-4 years, it's obviously strengthened due to demand, and it's now gone up to a crazy level. Is it going to continue? In our view, yes, partly thanks to this chart here, which shows you the demand for electric cars has gone up dramatically since 2010. You can clearly see, and it's peaking because the electric car sales have doubled from 2020 to 2021. Did you know that? Car sales have doubled in a year. The demand for electric car sales in the next 3 to 5 years is so big that supply cannot keep up with it. And when supply is short and demand is high, what happens? Prices go up. So because of this, we think there are companies like Allchem, AKE, which was formerly known as Orocobra, are primed to benefit from this. Now, Ed, this is a company which have got operations all around the world. They've had offices in Argentina, but they also have their offices in Brisbane and Perth. They have multiple sites around the world, and now they're the 5th largest lithium producer in the world. There's a lot to like about them.
Absolutely. Along with the acquisition or the merger with Galaxy, made this stock now top 5 in the world, and they're well advanced. In particular with Orocobra's assets, they were first to market here in Australia. I remember when I first started, Orocobra was like $1 a share in our mining report. We've had multiple buys since then, including the midweek alert that we put out in 2020 at $2. I know a lot of members bought that stock, so that's another 10 bagger in under 2 years. But this stock is infrastructure ready, so they're well ahead of the other lithium explorers in the country. A lot of the lithium explorers in Australia have just got land leases signed. You know, they're at rock sample stage. You know, so there's a lot of hype around those. They've delivered nothing yet. So you've got to make sure that they're actually producing and they're signing offtake agreements. Well advanced lithium projects are the ones that we're focusing on. These companies have a very strong future. But Allkem is first to market. We're very proud of that achievement. We've stuck solid with the stock. Now the stock previous to COVID, the year prior, I think it hit a high of $7 and dropped back to $2 during COVID. So for us as value investors, it was an absolute no-brainer, you know, to warn all members that this was an absolute fantastic buying opportunity. As it turns out, you know, the stock's back at around, you know, $13, $14. So it's a fantastic opportunity at the moment. So this stock will probably go consistently from here on. Yeah, there'll be a bit of volatility in between when the dysprosium price moves up and down. But you know, $14, $15 is where we're looking at this particular stock.
Absolutely. Well, this is the big gains have been had. Let's just be honest. We're still giving you this as a buy recommendation. We do think this is still going to go higher into the high teens over a period of time. But look, the big gains have been had. The key is buying in early, and that's what we're here to advise you. Buy in early, hold, buy on the dips, accumulate, dollar cost average, and just continue to hold good quality solid companies. So this will be a great example. That brings us to the hidden gem number 2, and this is another lithium company, but a junior company with excellent infrastructure and a few more points for you to look at. So first thing first, this company have got 11.2 million tons of lithium grade, which you can see in the orange line here. And we do a comparison with another company, which is GL1. Now, we don't own GN1 and we're not recommending that to you, but a comparison between this hidden gem versus that one. They have 10.5 million tons at 1% lithium grade. The other thing is they're both at advanced exploration. The scoping study has been done, but the other thing we like about this hidden gem is they don't have currently an offtake agreement in place, whereas GL1 does. Now, this is a huge advantage for this company, for the hidden gem, and the market cap is only 125 million, so still a small cap, trading around 55 cents a share, whereas the GL1 have already advanced to the next level. The market cap is 4 times more, and the share price is $2.46. So we think there's a huge potential for this hidden gem to go to that $2.50, $3 and beyond. And here's a few reasons why. So Ed, I'll pass it on to you, but this quality lithium resource that they have, 11.2 million tons, that's got to be exciting.
Yeah, absolutely. So again, infrastructure ready. They've got a few fingers in the pie, so they've got a few joint ventures happening. One in Canada. It's well funded. Also, their shares on issue nowhere near some of the smaller rivals. So not a lot of shares on issue, which makes it a very attractive proposition. They're focused on funding and producing. I've also got a few tenements in gold as well, so that they are multi-commodity, not just lithium. So market cap 125 mil, 9.5 million in cash in the March quarter, 244 million on shares on issue and 23 million options. And their project tenure is 453 square kilometers, so it's huge. So the scope to find more deposits in that tenement are very high. And like I said earlier, 200% owned gold projects in the gold-rich Kalgoorlie region is the reason to consider this stock as part of your investment strategy. So this is the type of stock that most of our fully invested members, especially our income investors would consider as a stock to add a bit of variety to their portfolio. It wouldn't be the be all and all of your investment strategy. It'll be part of your investment strategy. It'll be the smaller, riskier part of the investment strategy. And that's why we have our mining portfolio, which is very popular with our longer term investors. They can add a bit of variety to, and the ones that have, picked up the chalices and some of the others have done very well on top of their income.
Yep, excellent. Well, you can see on the charts here, yeah, it's not a smooth sailing. It is a little bit volatile, but all in all, if you bought it last year, I mean, at 8.6 cents, it has now gone up to around 55. It has been as high as 72 cents, but now 55. So that would have given you a 540% gain. So 10,000 would be sitting on 64 at the moment. But again, that just proves the early bird advantage. Having said that, if you want to take advantage of this up and coming lithium huge mining company, we believe this has got every chance to get up to that $2.50, $3 and beyond over the coming years. So even if you invested $10,000 today at 55 cents, you still have a good chance of turning that into 5 times or 6 times your investment. That's our belief. So we're happy to provide this to anyone who's interested in investing with us and happy to work with us. Now, to give you an opportunity, firstly, we'll just share with you our performance first as to how we've been performing over the last 22 years. And this is where really the boys are separated from the men, because a couple of our competitors have been, at it for 1 or 2 or 3 years or 5 years, and they talk about 1 or 2 stocks. We've been averaging 17.8% annual returns across our whole portfolio of 55 to 80 stocks. That's our annual returns versus the market, which is 8.5%. So we've been outperforming the market by 9.3%, not on 1 stock or 2 stocks, across the entire portfolio. Now, we're proud of this. There's no doubt about that. And we will be happy to share this, because this is all on our public website as well. So we don't hide anything. Everything is on our website. You can check it out. These are all audited, real returns. Now, we also break it down per year. You can see that 2020, 2019, etc. Look, we do our best work when the markets are down. So you can see 2015, when the markets were down, we had a fantastic year where we actually outperformed the market. 2018 was similar. The markets were down and we did a pretty good job. And 2016, 17 would double the market. Are we perfect? Do we get it right all the time? No. Look, 2019 is a good example. The markets actually had a fantastic run, 24%. We did 19%. So yes, you can say we didn't get it right that year. We underperformed the market, and we will take it. We understand that we could have done better, and we didn't. But all in all, look, generally speaking, more often than not, we will get it right. And if you're with us for a few years, you will see the benefits in your portfolios. And that's why we're a popular company. This is an illustration of compounding returns. If you get a 17.8% annual returns and you can maintain that for 20 years, a $10,000 investment back in 2000, topped up with 5,000 per year, would now be worth $1.6 million. So just to give you an example of long-term value, holding quality investments over a long period of time can get you a solid return. Now, Ed, we've got a number of people who back us up. We've got 25,000 members. A lot of them have provided reviews on their own on an independent website to share their experience with us. You've probably spoken to a few of them too.
Yeah, we picked a few of these off product review, and they're very familiar because I've been here for 11 years. A couple of them really stood out, and they're the ones that we and a couple of our account managers sort of identified with a few of them. So these are real reviews. We don't ask members to put a review up. They put it up on their own accord, purely because their portfolio has benefited. They're so excited, so they go do something about it. They want to share it with others. A lot of our new members are referrals from these members. A lot of them get their kids to start investing. I had one gentleman, he bought 3 membership packages for his 3 kids to get them started. to get him investing, because he knows how well he's done over the last 20, 30 years in the market. So he's spent the money, he's got them started. A lot of them have bought some of the income stocks and some of the mining stocks in the last 2 years, and they're definitely well ahead. So you can read it for yourself. Again, this one's a beauty from David Galloway. He's a retired stockbroker, so he could see clearly the value of the service. So he's using the service as well, and appreciates Angus's daily macro report, which is one of our most popular reports. Our members that are fully invested and long-term members, they don't chop and change the portfolio much, really appreciate our daily report from Angus, because it's all macro. He actually tells you where the money's invested, in which portfolio, names the stock, and that's an opportunity for you to review for your own portfolio. So you can read them for yourself, but again, the service is qualified. It's been qualified for you for 22 years. All the hard work is done. We're not a startup. We're not a direct marketing company from the US. We're not a bucket shop out of Mumbai. We're not a name that you just heard in the last 12 months. We're a legitimate research service. We're the leader in the industry for the self-guided investors. We give you many, many reasons to join. One is our performance. 18% over 22 years. These are audited results, externally audited. We pay an auditor to audit our results, and these are the figures that we put on our public website. So most of our competitors provide insights, or they push one or two stocks, usually highly speculative stocks. We have an actual research portfolio. It's a portfolio of stocks that you can log into on the website. You can click Fat Profits Portfolio, and you can see all the stocks there, the first day that we bought into the stock, and the latest review. It's all there in black and white. We save you time and research. We do all the work. All you have to do is just follow it and read it and get the ideas for your portfolio and follow those stocks. Experienced and reputable management. Like I said, most of our people have been here for over a decade. And in particular, our account managers that look after our members, usually the senior account managers. 7 out of 10 winners. That's a 70% strike rate. It's the old 80-20 rule. If you can get 80% right, it usually covers 20% of your losers, and you'll make money in the market. Well, ours is about 70 to 10, so 70%. So we've done very well there. No marketing or upselling. We're not a direct marketing business. You do a little bit of advertising, but most of our updates are our investor updates, which is this webinar that you're on today. Most of our resources are put into our members research and supporting our members long term. So yeah, that's how you'll benefit from the service.
Absolutely. Thanks, Ed. So these are a few reasons for you to join. Now, before we get into a special offer for you today, I'll explain to you what are the options available. In fact, we've had a comment earlier from Jenny. She's saying, I know a couple of members of Fat Profits, I guess maybe friends, and she mentioned that yeah, they're quite happy with your service. So do you have any special offers? So yes, Jenny, we're about to explain that now. So these are the 3 types of memberships we offer, and we have a standard membership, premium, and platinum. Now, regardless of which one you go with, we will issue a tax invoice under your personal name or your self-managed super fund or whatever you prefer, and they're generally tax deductible, but obviously you speak to your accountant to make sure you qualify. Now, how this works is simple. All the 3 memberships, they have 3 things in common. So first one is the daily Fat Chat market commentary. So that's an email from our CEO, Angus. He emails you every morning before the market opens. That's a market commentary, and he provides a lot of updates on what's taking shape and market direction. A very good email. He gets up at 5 a.m. every morning to write that long email with lots of charts and lots of quality information for you to assess what's taking place. Number 2, you get a weekly members only webinar, which is every Thursday at 12 p.m. for 1 hour, Sydney time. So every Thursday, 1 hour webinar live from our Fat Profit studio, where our analysts, our CEO, they will all join in, talk to you as a member directly, and also you can ask questions as well. So it is back and forward. And in that webinar, we will cover about 15 to 20 stocks, buy, hold, and sell, avoid. We'll also talk about the markets and any changes that are taking place. So a very good webinar. Now, if you missed the live session, that's okay. You can replay the recording later on as well. So that's not a problem. We email the recording, so don't worry. Number 3, Friday Fat Wrap. Now, that's not a kebab wrap, so it's just a Friday Fat Wrap. That's just the name for our wrap up of the weekly highlights that you may have missed out on. So those 3 benefits you will receive regardless of what membership you take. Now, the difference between standard, premium, and platinum is we publish 4 weekly reports. So the first one is Australasian equities. That covers Australian market, a little bit of New Zealand, and a little bit of Asia. So if you're interested in that, that's a must to have. Second is mining report called Global Mining. Now, even though the name is Global Mining, and it does have some international companies, but 80% of the mining companies are Australian based or Australian miners listed on the ASX. So for mining and growth opportunities like Chalice Mining, CHN, or the hidden gems, that's where you should really subscribe to that. Number 3 and 4 are global and UK equities. So UK is obviously for the UK market. Global equities is for international markets like US, Europe, or Asia. So depending on what you want to subscribe to. So if you're going to be a standard member, you will get access to 1 of the 4 reports. Premium, you can choose 2 out of the 4. And you will also get a premium account manager, someone you can speak to or email if you have questions about a stock or the markets. And that is really handy, especially when you're tossing up whether I should sell a stock or I should hold. And last one is platinum, where you have access to all 4 reports and the account manager. So typically speaking, most of our new signups, and there's obviously a lot of you watching this right now, would usually go with the premium for the Australian market. If you're an international investor, then you go with the platinum. And if you're really an entry-level new investor, just getting your foot in the door, you may just try the standard membership. So those are usually the cases. Now, just before we get into the offers, I also want to highlight a little bit of our members website. So if you can see the screen there, can you see that screen, Edward?
Yes. Yep,
Okay.
it's clear.
So if you can see in the members website, when you log in, just a bit of a sneak peek, when you scroll down, you'll see these are our 4 research products. We don't have any other products, by the way, just to clarify. So once you subscribe, you won't be bombarded with other products for you to subscribe, which is very annoying, right?
Yep.
So you've got Australian equities, UK, global, and mining. Now, Ed, if you're subscribing to Australian equity, these are the few tabs. Maybe you can just give us a quick snapshot of what they entail.
Sure, latest weekly report, and everything's archived. So everything's got a calendar. So when you join, you can see exactly what we've recommended in the past. So latest weekly report, Tuesday night for Australian equities. We'll update you on about 5 or 6 stocks. There will be some buys, some holds, and potential sells with the research to back it up. And occasionally we do sector reviews. So recently we did small cap healthcare stocks. We did education stocks. We did a piece on a buy now, pay later, for instance, all areas that we don't cover. And then you've got new recommendations that are archived for about 3 months. So even as a new member or an existing member, you can log in straight away, click new recommendations, and you'll get all our latest buys. And it remains a buy until we've changed it. So it might be a buy from 3 or 4 weeks ago. Yes, it's still a buy. If the share price has gone up about 15, 20%, you can email or call your account manager and clarify whether it's still a buy. And the same if it's gone down. Well, if it's gone down, it's actually a better buy than what it was back then. But that's rarely the case. So then you've got past recommendations where you can see all of our past predictions. Just prior to that, just up there, Pat Profit's portfolio I was speaking to earlier. This will list all of our preferred stocks in the market, the first day we recommended it, and the last review on the right-hand side. And you'll click on that where it says Fat Oz and a number there. It'll take you to the weekly report. You can read the research on that stock. Further down, you've got midweek alerts, sensitive announcements on stocks, up and down. we'll archive them in this section. Latest income report, we spent some time on that earlier. Very popular part of our service and a very successful portfolio for over a decade. Big part of what we do under Australian equities, and I'd highly recommend you spend a lot of time reviewing that section. Again, all the past reports are archived, and live research webinars. This is where we post all our weekly recordings. So the weekly webinars on 12 o'clock Eastern time every Thursday, and we post it on the website, and we actually send our members a recording as well. But I think it's about 30% of our members actually attend it live, and they're usually members that don't work full-time, self-funded retirees. They've got plenty of time on their hands, and that's a major event for them. So they really look forward to our weekly webinar and ask lots and lots of questions. So yep, that's that.
Yep, excellent. Thank you, Ed. So now for you, I'm sure a lot of people are now waiting for the price. So on our website, and if you go to fatprofits.com.au, you're going to go to about, and you can see the products, you can see our performance, everything we've highlighted is all on the website. And you go to products, you can see the difference between standard, premium, and platinum. These are the retail prices. So standard is only $1,095 a year, a little bit cheaper if you go for 2 years, and you can pick one of the 4 reports, whichever one you want to subscribe to. Premium is $1,545 a year, and 2 years is obviously a bit cheaper. That's the most popular bundle for Australian investors, and that's what probably most people go for. And platinum, which is only $25.90 a year, fantastic value, and 2 years gives you a bit cheaper, a bit of a discount there. And for people who are looking to get into other markets outside of Australia, well, this is great value because you only need 1 or 2 good stocks to cover either or, whichever one you go for. Now, the good news is that out of these, we're actually offering a pretty special deal today, and we've got it right here for you to take advantage of, because it is the end of financial year and it is tax deductible as well. So here's the special prices. So if you go for the standard membership for 1 year, we can discount that to $8.95 for 1 year. Pretty simple. Get an entry into the service, not a problem. Premium, which is very popular, we have a number of deals here. So first one is you can go for 1 year, and that's down to $11.45, so pretty good discount. If you go for 2 years, then we can bring the discount a little bit further down. It's only $8.99 per year for 2 years. That is a very good price. And last but not least is the best value. If you go for 4 years, then not only we bring the price down a little bit further to only $7.49 a year, which is not a lot in the stock market, and that works out to be $2,995 in total. But with that, we will also include a one-off portfolio review of your stocks that you're currently holding, and we'll come back to that in a moment. Platinum, which has obviously got all the bells and whistles, 1 year we brought it down to $19.95. 2 years is a bit cheaper, that's for sure. So if you're going to go for that, either 2 years, great value, or 4 years is certainly the best value. Now remember, you saw the price on the website a moment ago. $46.95 is normally a 2-year price. We're prepared to give you 4 years for the 2-year price, which is only $11.79 a year. And with that, to give you more value for your money, we're including an annual portfolio review every year for 4 years. Now, typically that review by itself is worth around $1,000 by itself. We're giving 4 of those plus our best service. So certainly Platinum has a lot of value as well, and especially with end of financial year being tax time, you'll certainly benefit from either or. Now, Ed, I'm going to just put up a poll for our audience today. Now, while we get their selection, and typically a lot of people at this point in time would make a selection between the choices. I'll take a question here from Jonathan, who's asking about the portfolio review. So he's saying, if I join the premium service for 4 years, what will that portfolio review look like?
Yeah, absolutely, Roger. And just before I answer that question, this poll is not a survey, so please don't click anything if you're not genuinely interested in joining or not interested in discussing our service further. Happy to take questions. any questions about the service before you consider joining, but it's not a survey, so please don't click unless you're genuinely interested in joining, because we will call you and we will have a discussion about how we can assist. Now, secondly, now to answer that question, the portfolio review, usually we go through stocks we prefer in the market and which ones we don't prefer. I do have a look at sector weightings. I look at whether the stock is ripe to take profits. So for instance, there's one that I did on Friday, which the gentleman was tech heavy. So he came over from one of our competitors. You know, they have, I think he told me they have 12 subscriptions. He subscribed to about half of them and ended up with 5 different portfolios, and most of them were high growth stocks. So stocks that were tech heavy, you know, stocks that are similar to the ones listed on the NASDAQ. So he invested in all high technology, you know, high growth stocks, and no word of lie, he's lost about $500,000 of his hard-earned money. This gentleman, you know, manages his own business. So we've given him a fresh start going forward. We've said, look, these are the stocks we prefer in the market. There wasn't many, to be honest, because they were all high growth. With very little return, so he's lost a lot of his capital, and this company didn't recommend any mining stocks. So pretty much for the last year or two, he's completely missed out on the super cycle, the mining boom. He had zero mining exposure to his portfolio, and also didn't have a lot of income stocks as well. So you can just imagine how bad this portfolio looked. So we give him sector weightings. Yeah, we'll tell you whether you should consider cutting a loss on the stock. We give you some ideas whether you should consider accumulating more stock, and also some ideas whether you should be taking profits, and also some ideas whether you're overweight on the stock and how you can balance that portfolio and maybe improve some of your underweight stocks as well.
Well, that's great value. So look, certainly with the premium or platinum, you will get advantage of that. So thank you for that question, Jonathan. We've got another one from Kate and David. Looks like they're watching it together. They said, thank you for the presentation, guys. It's been quite informative. The question for them is regarding the tax invoice. So they're saying, we manage our own self-managed super fund. Can we get the super fund to pay for this? So the answer is yes. I'll answer that question. Yes, Kate and David, yes, your super fund can pay for this. We will make the invoice under your super fund. Most of our 25,000 members, they're self-managed investors, so they use the super funds to pay for it. That's not a problem. We can do that for you, so just let us know. Now, from what I can see here so far, look, a lot of people have chosen premium. There's a couple on standard, but there's also about 20% on platinum. Looks like some people interested in international markets too. So we will get in touch with you guys. Thank you for your interest. Now, for the others, if you're watching this as a free webinar and just looking for free information only, which is fine, we're happy to provide that to you. However, you have to ask yourself the question, are you doing a better job than a company like Fat Profits? We are producing 18% returns per year for 22 years. So, you know, be honest to yourself. What are the chances of you producing that return consistently for such a long period? Very, very slim. So if you're still tossing up whether you should join our service or not, well, it's really, what have you got to lose? You have nothing to lose in these volatile markets. Let us help you. Open your minds. Give us a chance, because if you don't want to change anything, your results will not change. But if you're really, you know, strong about wanting to do something, well, it all starts today. Give yourself a chance, shake our hand. We've given you a very good price. Come on board and let us help you. Ed, over to you.
Yeah, the membership pays for itself, Roger. The amount of times I get members calling me back within a month or 2 months or 3 months, they bought a few stocks and they said, look, I bought 6 or 7 or 8 stocks out of your recommendations, and I've built a pretty happy portfolio, I guess, and already my membership's paid for itself. So, and some people just get back to me and say, I bought one stock and it's gone up 15-20% in the last month or two, and that's also paid. So the membership will pay for itself. There's a tax deduction there for people that can get it. But the membership will definitely pay. We gave you enough examples today to show you how the membership pays for itself. The whole idea of presenting this webinar is to show you what we do, how we've done it over a long period of time, how you can benefit, and we're obviously giving you an incentive to join, and we want new members to join. I can see people on this database, Roger, that have been here since 2009, 2008,
Yes.
2014, 2013. But a lot of those people, sometimes they take multiple webinars to be convinced. That's fine.
Yeah.
And sometimes it's just timing. Most people join when they're ready to put new money into the market. You could go in blind and lose 20% of your capital in this market, or you can invest $1,000 or $2,000 or $3,000 on quality research and get off to the right start and make sure you're not in the BHP scenario where you're 20, 30. I get members coming in and say, oh, I watched your webinar, I went in on my own, I've lost 20% of my money, and now I've realized that I probably should have just joined you.
I
And
know.
I probably would have bought completely different stocks, and I probably would have a completely different result, which is potentially right, depending on what you buy and when you buy it. So timing is key. But yeah, most people I've spoken to in the stock market over the 20 years I've been in get research from somewhere. They'll either get it from a full service stockbroker, they subscribe to a couple of research firms like ours. It's occasionally I hear some hard luck stories where they've spent thousands of dollars on copy and paste stuff where they tried someone out that was new and got nothing out of it and lost a lot of money. So that's just
Yeah.
bad luck. You learn from
Yeah.
those mistakes. But everyone that invests in the stock market successfully over a 5, 10, 15, 20, 30-year period uses research, and you get the results over
Absolutely.
that time. So
Absolutely.
that's
All right.
pretty much it for me. But again, this
Oh,
is not a news poll, so please
yeah.
only click if you're generally interested, and happy
Yep.
to take questions for members who want to click. I would like to discuss further. If you're not convinced, click it. We'll have a chat, and we'll see where you're at.
All right. Thank you. Well, we're just about to close this now because I think we've had enough responses so far. So to really look for the others, there's only two choices. Either you carry on doing what you're doing and get the same results, or you want to make a change and give us a shot. So I'm going to close this now, and we wish everyone all the best. We've done a reasonable job in reducing the prices as well. So finally, look, if you do have any questions, you can email us at info@fatprofits.com.au, or you can call us on 1300 88 1177, and we'll be happy to help you. In the meantime, look, my name's Roger. Thanks for your company today. We hope you learned something from it either way. If you're willing to join us today, then yes, great, congratulations, welcome aboard, and we will call you and work it out and help you on your investing journey. If you're still tossing up, well, look, think about it. If you're really serious about making some changes, then we encourage you to think hard and do something on it today. And finally, I'll pass it on to Ed for his final words.
Sure. Thank you very much, Roger. And thank you everyone that attended today. If you'd like to discuss the service further, my name is Edward. Obviously, there's Roger. You can email us or call us. We're happy to have that discussion with you, where we're both the senior guys here as part of our research service. And we look forward to welcoming some new members on board today.
Okay, bye for now.